On August 6, 2026, Zurich Insurance Group reported half-year earnings that cleared the highest bars set by analysts. This data visualization illustrates the scale of the win. On the left, we see a record $4.8 billion business operating profit. Alongside that, the core return on equity reached 27.1%, significantly outpacing the company's internal targets. Yet, as this intraday chart on the right indicates, the market immediately rejected the beat. The stock sold off by over 3% upon the announcement, compressing down to 590.40 Swiss francs. This creates a textbook valuation paradox. Institutional investors are looking at secular, compounding growth and choosing to actively discount it in favor of unpriced risks. That discount stems from three specific variables: rising expense ratios in isolated segments, the integration mechanics of a massive pending acquisition, and localized regulatory friction in their domestic market. Reconciling the record-breaking headline with the actual stock performance requires examining the structural risks of Zurich's M&A strategy and the governance issues raised by its domestic regulator. We begin by analyzing the composition of that $4.8 billion operating profit to isolate exactly where the capital is being generated. This waterfall chart breaks down the results by segment. The property and casualty segment acted as the primary driver. Jumping 16 secondary engines provided further support, with life insurance hitting a record $1.3 billion and farmers contributing $1.2 billion through accelerating channel growth. CEO Mario Greco noted that the company is currently operating ahead of all its mid-cycle targets. With the core property and casualty engine operating at this level of efficiency, the market's anxiety is clearly not centered on Zurich's ability to underwrite traditional risk. Within the property and casualty results, the most aggressive growth is occurring in global specialty construction. Construction premiums surged 18% year-over-year. This surge is tied to the massive capital requirements of global artificial intelligence development and the subsequent race to build large-scale data centers. This map highlights Zurich's geographic expansion to capture this demand. They are currently underwriting new infrastructure hubs across Brazil, Germany, Italy, and Spain. Because these AI data centers are so capital-intensive, Zurich is exploring insurance securitization products to distribute the highly concentrated risk associated with these builds. Parallel to data centers, global energy infrastructure projects are compounding this same demand for construction coverage. Underwriting these complex, high-margin projects ties Zurich's growth directly to the physical expansion of global data networks and power grids. Despite those tailwinds, a significant weight on the stock price remains the pending acquisition of Beazley plc. The deal structure is massive. Zurich is executing an £8.1 billion or $10.9 billion all-cash buyout, which was approved by 99.9% of Beazley shareholders. To fund this, Zurich executed a 3.9 billion Swiss franc equity placement in March 2026. Strategically, the move bolts a premier Lloyd's specialty footprint, covering cyber, marine, and healthcare, onto Zurich's balance sheet. An entity combining this degree of global scale with this specific depth of Lloyd's specialty risk does not currently exist in the London market. The complication is that the deal has not yet closed. The final steps are currently moving through a labyrinth of global regulatory approvals. On this regulatory checklist, Australia's ACCC and the European Commission have already provided clearance. The remaining hurdles for a late 2026 completion include the UK's PRA and FCA, Lloyd's of London, Switzerland's FINMA, and a final court sanction. The market is currently charging an execution risk premium, factoring in the potential for operational friction as Zurich attempts to integrate a complex Lloyd's syndicate across multiple jurisdictions. That anxiety is being compounded by a localized regulatory crisis playing out in Zurich's home market of Switzerland. The Swiss financial regulator, FINMA, has opened enforcement proceedings against Zurich's corporate life and pensions unit. This timeline outlines the escalation. During a routine inspection, FINMA discovered pricing violations where corporate policies were sold at rates lower than those previously agreed upon with the regulator. The situation grew more severe because Zurich failed to implement the agreed-upon corrective measures in a timely manner. The immediate consequences include a sales ban on some new policies and the termination of more than 12 employees. Management maintains that this ban will have no material impact on the wider group's bottom line. While the financial damage may be negligible, enforcement proceedings suggest a breakdown in internal controls. This creates executive-level distraction precisely when the Beazley integration requires total focus. The analysis brings us back to the central paradox: a record $4.8 billion operational performance weighed down by integration and regulatory anxieties. This data matrix shows the analyst consensus from S&P Global. The market issues a cautious hold rating, with an average price target of 604 Swiss francs. Overlaying a baseline fair value estimate of 596.43, we see the stock trading efficiently at current levels. The stock's future depends on the balance between massive tailwinds from the AI infrastructure boom and the mechanical risks of the Beazley acquisition. Zurich has reached its long-term targets ahead of schedule, but the valuation will likely remain constrained until management proves they can integrate Beazley and resolve the regulatory proceedings, while maintaining their 92.7% underwriting discipline.